Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, Director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast. Welcome back, everybody. Today we're going to talk about uncertainty.
And particularly, we're going to talk about multiple different ways in which you can measure uncertainty. Those measures, when we look at them, can actually differ from each other quite a bit. And we want to understand from an expert how to interpret the differences in these different measurements. So let's start by defining what the different ways in which we can talk about uncertainty. The first one is when we think about uncertainty about economic growth, we can measure the volatility of, say, GDP growth, where GDP is the total production of a country. So if we have an economy that grows at about the same rate continuously, we say that that is a low volatility economy. If we're looking at an economy that sometimes has huge booms and grows by 6-7%, and sometimes has huge recessions and therefore shrinks by multiple percentage points, we say that that's a high volatility economy. And so by just studying over time how various economies do, we can come up with uncertainty measures for each economy.
So, Jules, I think we should take one step back here and just talk about why do we care about GDP growth? And I think most economists would say that that's fundamentally what people worry about, whether we're in recession or we're in a boom cycle, and that the common good of people are best measured by the rate of economic growth as measured by GDP growth.
For sure. But one thing that we also need to point out is that if you say look at quarterly GDP growth or even annual GDP growth, you have a very short horizon in terms of how you measure economic activity. Maybe people say, due to the AI revolution that we're going through right now, they have different questions in mind, like not so much about are we in a recession in the next quarter, yes or no, but what does the long-term growth rate of the economy look like over the next 10 or 20 years? And so if we are going to debate what those numbers look like, and these short-term volatility measures might not be the best thing to look at. And so one volatility measure that I think is particularly interesting that a lot of people look at these days is what's called the VIX. The VIX is essentially a forward-looking measure of the volatility on the aggregate stock market. And because the stock market is not just a claim to next year's profits, which are part of production, or even the next couple of years, the stock market is a claim to a whole stream of future economic activity and profits. And for that reason, the volatility in that claim tells us something more about what the long run volatility of the economy looks like. And that metric, Jonathan, actually varies a lot over time. If we look at the average volatility that the stock market has, it's about 18% per year. But we've seen periods, say, during COVID or during the financial crisis, where we see that volatility spike to as high as 60 to 70%. But there are also very long stretches of time where that volatility is actually quite low. So as low as, say, 10% or so.
And Jules, let me just take one step back here and emphasize why another very important reason why people care about volatility in the stock market and care about the VIX, because you can get the measure in real time, right? The problem is it takes time for economic data to come in. So by the time you find out that GDP is very volatile or has gone down a lot, you're already in the recession or you're already in the boom. But because the stock market is forward-looking, you will get a reaction to the stock market. If everybody thinks we're going to go into recession, the stock prices drop immediately. And so that volatility of the stock market should reflect total volatility in the economy. And what the VIX index is it uses option prices. And what's great about option prices is by cleverly combining options, you can get a pure measure of volatility without worrying about means. And so what the VIX is that pure measure of volatility.
Now, a third measure of volatility, and that is really where our guest is going to have a lot of expertise, is that, of course, recently we've seen a big revolution where text is generally also considered to be data. In the past, data was generally considered to be things like numbers, like growth rates and other things. But due to the arrival of large language models and AI, of course, we can now also take text and quantify it and use it as an informative source, even about things like uncertainty.
But Jules, of course, that text is a real-time measure as well, like the stock market, because you can look at what people are writing now about the future. And so it's an alternative measure of future volatility, which is kind of interesting.
Very interesting. And so when you look at newspaper articles of major outlets like The Economist or the Wall Street Journal or the Financial Times, then you can see from the word choices and the number of times, for example, that journalists are talking about uncertainty and uncertain events, you can make a lot of inferences about apparently what keeps people busy in terms of what their level of uncertainty is at a given moment in time. And indeed, you can even do that on a daily basis. So you can just ask the question, how often are these uncertainty measures spiking in the short term in the next couple days? We can really use today's newspaper to measure in real time what the amount of uncertainty in the data looks like. But Jonathan, one thing that has really puzzled us, I think, and hopefully Nick is going to give us a lot of insight on this, is that what can we take away from the fact that, say, the VIX is not elevated, but the newspaper measures are hugely elevated, and we're not in a recession? So if I have those three pieces of information, what am I supposed to do with that information? Or vice versa? What if the VIX is spiking, but in the newspapers, we're not really seeing a pickup in these uncertainty measures? And I think that trying to understand better where these discrepancies come from will be very informative for our listeners. So first of all, I think it's good for our listeners to become familiar with the uncertainty indices that Nick, our guest, has built, how he has built them, and what we can learn from it. And then hopefully also how they can use these uncertainty measures in their business decision-making practices.
Okay, so I think this is a good time to introduce our guest. Of course, is a return guest to the show, Professor Nick Bloom, who is the William Earbley Professor in the Department of Economics at Stanford University. And I would say the person who has pioneered this way of thinking about uncertainty, using text-based methods to introduce a different measure of uncertainty. Nick, welcome to the show.
It's great to have you, Nick.
Thanks so much for having me back on again.
Yeah, so today we're talking about a different topic than last time. And we're talking about, I think, some really important work that you've done that's also been incredibly influential in terms of framing the debate around the importance of uncertainty and the influence that it has on the decisions of households and firms. And maybe to kick off the discussion, can you tell us a bit about these uncertainty indices that you have developed? What motivated you to look at them this way? And how do you take information from various places to arrive at these aggregated metrics?
Great. So, I started working on uncertainty during my PhD, which goes back to the mid-90s. It's kind of aging me a bit, but more than 30 years at this point. And it was, I think, 2007, 2008, just before the financial crisis, where there was a lot of concern over political uncertainty. So at that point, it was the Republicans attacking the Democrats over political uncertainty. And Steve Davis and I decided, well, how are we going to measure this? It's not easy to measure political uncertainty. There are measures of financial uncertainty like the VIX, implied volatility and other measures. And so we started slowly, which was scraping our newspapers. And this thing just grew and grew and grew. I'd say there's three ways classically people now would measure uncertainty. And one of them is what I'm talking about now, which is text. So you go and scrape, for example, the leading US newspapers like, the Wall Street Journal, the New York Times, the Dallas Morning News, etc. For the frequency of words like uncertainty, you can say, are they near policy words? Are they near economic words, etc.? Or I have some other stuff looking at things like the Economist Intelligence Unit monthly country report. So there's a kind of a text-based literature which looks at uncertainty. There's the second one, which is financial markets, which is probably everyone's aware of. Does the stock market bounce up and down a lot? And then the third is more classical, just surveying people, asking them, is uncertainty higher or lower? But I've really focused recently on the tech stuff.
And so these measures can actually give quite different answers. We'll go into sort of the differences between financial metrics and others. But if you compare the last two, the surveys versus the text-based stuff, do you find common patterns or are there quite big deviations in that?
Yeah, so this is the puzzle of the moment. And I was talking at the Fed and the New York Fed and the Bank of England, etc. So I just explained the history, why it's such a puzzle. So until about 7 or 8 years ago, all three of these measures moved really closely together. So every time you saw lots of mentions of the word uncertain in newspapers, the stock market was bouncing up and down. And when you survey business people, they'd say, we've no idea what's going on. In fact, we have a daily measure called the Economic Policy Uncertainty Index, and there's the daily VIX, and those two move really tightly together. In fact, so tightly that Bloomberg, Fred, Haber, etc., all carry our indices. And I know that it's been used by a lot of hedge funds because every time our scraping broke, would receive a ton of inbound emails of people saying, where is your data? So that sounded great. And then what has happened in the last few years, particularly in the last 2 or 3 years, is they've really diverged. So under Trump 2 in particular, text measures of uncertainty have just exploded. They've just absolutely ripped up. And so now they're like 2-3 times the level of what they were, say, in the 2010s or the 2000s. Whereas market measures, say the VIX implied volatility or the MOVE index and implied vol on the bond prices or surveys, are kind of average. So you have text saying uncertainty is a 10 out of 10. And then you have markets and surveys saying it's about a 5 out of 10 and it's no more than normal. And it's a conundrum as to which one is right and which one is wrong. Or maybe they're talking about different things.
So what do you think? You must have an hypothesis what's causing this difference.
So I have two views. One is we scrape a lot of different types of text, but it's primarily newspapers, things like the Economist Intelligence Unit, IMF, World Economic Outlook, etc. One view is the people that write that stuff are just obsessed with Trump. And they talk a lot about Trump. They talk a lot about uncertainty. In British English, it could be called the chattering classes. They're kind of, college-educated folks like us, probably most of your listeners. They are, whether you say they have what is it called, the Trump derangement syndrome, whatever, those folks call it, but they're very Trump-focused. So one view is it's a mistake. Uncertainty really isn't that high. It's just that the media tends to cover him a lot. The other view is, no, there is genuine, real uncertainty out there. We think of, the changes in the US political system, the wars, issues of immigration, the weakening of NATO, etc., the change in trading arrangements. These are real things, but they're longer run, and they're not that well picked up by markets, and they're not that well picked up by service firms. And my sense is it's somewhere in between. One indication to tell you it's somewhere in between is we have actually 2 daily economic policy uncertainty indices. One is using the 10 leading newspapers, which are the ones you've heard of, which will be the New York Times, the Wall Street Journal, etc. That has absolutely exploded. The other one uses about 2,000 local US newspapers. So these are almost all papers you've never heard of. They'd be like, I don't know, the Oklahoma Daily Beagle, or just weird kind of local newspapers. That thing has not gone up nearly as much. Why? Because it's much more focused on kind of local business stuff, and it's less focused on international affairs and what's going on in Washington. So I think uncertainty, if I was to put a number on it, is a 7 out of 10, but it is not epically high like some of the headline mainstream newspapers claim, but it's not as low as the market seem to imply based on limited volatility.
But Nick, what could be more forward-looking than the stock market?
Well, there's some issues with the market. Look, I'm a big believer I'm an economist, like you guys, market's always right. The issue with the stock market is it's overweight in certain sectors. So it tends to be very overweight in tech. It tends to be overweight in finance. It's kind of underweight in manufacturing, actually, agriculture, retail, etc. And B, it's focused really on one number, which is earnings. And, to the extent to which effectively long-run valuations and earnings aren't uncertain, but there may be other things that are uncertain. Say politics, if, businesses remain profitable, but say a dictatorship was to come in, that wouldn't typically show up that much in stock markets, but it would show up in the newspaper. So the other thing you notice about markets is they tend to be very sensitive to bad news in terms of uncertainty. So anyone in finance knows this, it's part of the skew that basically bad news is associated with high volatility. So in my PhD, I looked back at all the big spikes in vol. And every one of them, when you looked in the market, you go back into the history books and you'd find an event. For example, I didn't know about Kent State, the student uprising in the early 70s. And, you find I went to read Business Week and it said one of the biggest threats to the fabric of society is the protests against the Vietnam War, etc. The assassination of JFK, the Cuban Missile Crisis, all these things generated big spikes in vol. What doesn't show up is things like the fall of the Berlin Wall. So the markets were like flat through that because it's good news and it's kind of longer run, but that generated tremendous volatility. So they kind of seem to focus on the negatives and less the positives. But for the negatives, they're good for picking up volatility. That's right.
So, Nick, I have this saying, the greatest piece of English literature ever written is Chicken Little.
That I don't know. I was not taught that at school. Shakespeare I did. I wish I was given Chicken Little. That might have been easier.
Okay, so let me define what Chicken Little is. It's this little chicken that walks around telling everybody the sky is falling. And he gets all the other animals to follow him and get into a paranoid state. The sky is falling, but of course the sky doesn't fall. So isn't that maybe an explanation of what's going on, that the newspapers exploit that human failing, that people tend to get worked up about things that are not so bad?
So that's totally right. So, there's a saying in the media called, if it bleeds, it reads. And it's completely true, particularly in English language media, that you tend to cover bad news stories. Having said that, look, if a lot of business folks around the US are reading this media and panicking and getting stressed out, that's going to have real outcomes. As of now, March, April 2026, hiring rates and labor market turnover looks kind of bad. So in the US, labor markets, the rates of hiring are down to like a 10-year low if you take out the 2020 brief drop. Now, one view is, of course, this is AI. So people are kind of blaming it on AI. But I think the other things going on is businesses generally are somewhat nervous about what's going on now. Some of it is AI uncertainty, but I think some of it is like the Iran war, energy price uncertainty, other types of uncertainty. So it has a real effect. What matters ultimately is what's in the mind of decision makers, in a sense, rather than what's probably the ground truth.
So we wrote this paper about these local newspapers where the only thing we measured was not so much uncertainty in the use of the word uncertainty, but just the positivity and the negativity on the way both economic news and regular news were being reported. And one of the most shocking things that I found from that measurement was that since 1970, we've been on a one big downward decline on the negativity of reporting. Meaning at the end of the sample, it starts in 1850 or something like that. And so it's almost 200 years of data. It's sort of stationary and mean reverting until about 1970. And then in 1970, we start this dive down that is just unprecedented. And in 2020, I think the news was the most negatively reported it has ever been on average since 1850.
Wow.
And so this does really make me wonder to what extent the capitalist model for journalism, where bad news sells, and as their profit margins get squeezed and they're trying to compete with each other, whether the incentive to become increasingly negative is just the outcome of that competitive process. Now, it wasn't, I think it was all newspapers, not just the local ones, including the larger ones that you mentioned. But I was quite struck by the fact that you found such a difference between these two sets of newspapers. Although I think that overall, also if we start to use more recent metrics and outlets for information, negativity is pretty large everywhere, both online as well as in printed media, wouldn't you say?
Yeah, I mean, newspapers clearly have to compete. I talk to a lot of journalists, and one of the things they're aware is that their stories also have this afterlife online. So now they know that, they go onto Twitter or LinkedIn or Instagram. And so the more shocking it is, and shock is normally easier to make on the negative than the positive side, the more it tends to circulate around. So that's kind of one of the reasons we've got these two different indices. Certainly the Wall Street Journal, I think, is still doing fine. The Financial Times, probably the New York Times. There are a few of the kind of banner newspapers, the big famous ones, are still profitable. I'm aware that as soon as you step outside the top four, or maybe even two or three, actually, they're facing major losses. All the Washington Post is very loss-making. And so, yes, that could impact what they're reporting. I should say we have another project because of this that I worked on. So with the IMF, we looked at the Economist Intelligence Unit's monthly country reports. So just to explain, the EIU produces these 30-page reports once a month on around 140 countries around the world. What do? They have take Ghana. They'll have somebody out in Ghana that's covering politics and economics. They write it out. They have an editorial process and going to format it, and it gets published. And it's aimed at multinationals, private equity folks, investors. It's not really a media thing. It's aimed at people that just want to know what's going on the ground and the truth in Ghana. If you look at that index tracks the newspapers pretty well for measures of uncertainty. And I don't think the EIU has different issues, actually, but I don't think it has the issue of trying to sensationalize it because his readers aren't interested in that. So it does look like, weirdly, text is obsessed with uncertainty in 2026, whereas markets are kind of shrugging it off. And it is a big divergence. And I've been asked a lot by, folks in the market, what is going on? Is uncertainty higher? Is it not? And We have two indicators that co-moved together for 30, 40 years and have now split apart in the last 18 months. And personally, I find it hard to know which is right. I think the truth is somewhere in the middle, actually.
So one other explanation, which you may like, is, of course, that there's a reason for why the stock market and financial markets are responding the way that they are, which is what a senior portfolio manager at Vanguard pointed out to me recently. Think about Argentina, for example.
As soon as Argentina got in trouble, the United States had no problem stepping in and creating the stability that that financial market needed. And so if there is, for a long time, we talked about what's called the Greenspan put, which was essentially the central bank stepping in and making sure that markets wouldn't become too volatile because we would just adjust policy to make sure that the downside was protected. If markets have the impression that Trump will just step in with government intervention if necessary on whatever topic, then maybe that could be a suppressor of volatility in stock markets relative to what is truly going on politically and in the world with the geopolitical risks that we're observing.
That is a great point. So the phrase that's become famous is this taco, or Trump always chickens out. But in a sense, he's often doing that strategically because he comes on with a policy. The policy doesn't seem to be working and he reverses. And in a sense, it's good that he reverses because the last thing you want is to double down with a bad policy. But the newspapers, of course, maybe don't report the reversal and panic when the policy starts, but the markets can see that reversal coming. And it's a little bit like what's happening in the Iran war right now. With gas prices going up, you can see that he's becoming more nervous about the war and, his moves towards peace. So you're absolutely right. That is another view. If you have policymakers, including Trump and the US president and the Fed, they're stepping when things are bad and the markets can see it, but the media can't, then in that sense, the markets are probably right.
Yeah, so I think that brings us, Nick, to a very important other part of your research, which is measuring uncertainty is one thing, but then how does that translate in the data to how we see households and firms, how they behave and how they respond to uncertainty? And I think you've done some very important work documenting that, particularly also for labor markets, uncertainty is not a good thing, right?
Yes, so I can tell you the stylized facts, which is when uncertainty goes up, you see a drop in hiring. You particularly see a drop in investment. Investment's much more sensitive, and in particular, long-run investment. Think of R&D or massive capital projects. Why is that? You've talked about it before on the show, but you can think about it as real options. So I'm a business. I'm thinking about hiring a bunch of folks, maybe opening imagine I'm a retail business. I'm safe for opening a new store. If I'm uncertain, I think, well, look, I might as well wait because, it's risky to open it. And I could easily find myself opening this brand new store, sinking $10 million in and regretting it. And so I just pause. And of course, if everyone in the economy pauses, interest is not just businesses. Christy Roma and Janet Eberly had a famous piece showing how consumer durable expenditure by households also falls when uncertainty is high. So effectively, everyone just gets cautious, and that leads to a slowdown. It leads to a slowdown, particularly in long-focused activity, which is most obviously business investment.
So in some sense, an unexpected shock to uncertainty itself could cause a recession, if you will.
Yeah, I'm very happy you asked me this because this is my PhD thesis. It feels like I'm back in my job market talk, 25 years ago. But I had a paper called The Impact of Uncertainty Shocks, which turned out I didn't know at the time, or not early on anyway, was very similar to something Ben Bernanke actually had done 20 years before, back in the 80s. But yes, exactly as you say, when uncertainty goes up, it can generate its own short recession. They tend to be relatively short and sharp because what happens, uncertainty goes up, everyone pauses. Businesses think now is not a good time to hire, now is not a good time to invest. Consumers think, let's not buy that new car, let's not move house. And so the economy tanks. When uncertainty passes, there's all this pent-up demand and it bounces back very fast. So classically, it generates sharp drops and rebounds. Interestingly, it looked a lot like the kind of thing we saw in the COVID pandemic, although we know that was driven primarily by the lockdowns, but it generates that kind of short drop and recovery.
This is a classic real options description of the economy, right? When the option to wait goes up in variance. So when you increase uncertainty, you increase the value of the option to wait, so people wait.
Exactly right. One other kind of example that's actually quite useful is there can be damage from persistent uncertainty. So I'll give you a current version of that, which is Brexit. So we have a paper recently come out looking at the impact of Brexit. I was actually able to vote in that. Yeah, I should be clear, I voted against Brexit. I wanted the UK to remain in the European Union, but I've been involved in a big group of folks examining that. And what you see in the data is initially there was no impact of Brexit on the economy at all. So the vote happened in June 2016. And the UK economy did fine in 2016, 2017, 2018. And year by year, it slowly is actually starting to diverge from the rest of Europe, from North America. And after 10 years, I won't re-go through the entire paper, but it looks like Brexit has reduced UK GDP by something like 6%. And partly it's breaking away from the trading bloc and, making it harder to immigrate. But a lot of it is just the immense uncertainty of the process. So anyone that knows what happened to Brexit, you're aware there was 5 prime ministers that went through that. There was Lettuce Gate. There was all the, the votes in Parliament, the changes of mind. Basically, for businesses, this was almost a decade of prolonged uncertainty. And that also can generate very long-run damage.
So, Nick, let's for a moment assume that the text-based uncertainty is accurately reflecting uncertainty in the economy. What do you think, besides Trump, are the other major forces that's causing that uncertainty?
I mean, the 2 big factors. One will be politics, and I shouldn't blame it entirely on Trump. This is a broader global phenomenon. I mean, highlight Brexit, and there's a lot of populist parties in Europe. Politics have, I think, honestly, driven in part by social media, of moving out the edges, and it's generating more political instability. So one bucket would be politics. I think the other is AI. So, we all, at least Jonathan and I, live in Silicon Valley. I don't know if listeners know, we're weirdly next door neighbors, although we're recording this in different locations. But AI is just everything. Every time I talk to any firm, any CHRO, exec, employee, I just had lunch with 3 former students. Same thing, AI dominates the discussion. No one really knows where it's heading. So I think the second bucket is around AI. And we have seen in my lifetime many technologies be introduced, like, the internet, the personal computer, the cell phone, etc. But AI and various metrics, I don't want to bore people with now, but it does look potentially genuinely different. So those are the 2 big drivers, I think, is politics and AI.
So talking about that dispersion in the effect of it, one thing that I would really like to hear your thoughts on is the geographical dispersion, right? So clearly uncertainty has different effects in different parts of the world. And, we are both originally from Europe, and, I'm worried about Europe and where it's going, also in terms of its economic activity, the growth rates that we're forecasting, the demographic changes that are happening, but also I think the regulatory uncertainty that is happening in that continent. So what are your thoughts on the influence of this type of uncertainty on the European growth prospects? And is there something that Europe could do to improve on that?
The best way that policymakers can help out is to try and reduce uncertainty by having stable policy processes. So one of the obvious ones is independent central banks. If you can predict that the central bank is going to set interest rates that will match some target, for example, if the Fed is the equal weight and inflation unemployment, it makes that part of the economy more predictable. If you can predict the federal government's going to try and roughly balance the budget, it makes it more predictable. If you predict that policies are going to be made by, Congress rather than the presidential whim, that makes it more predictable. So one thing policymakers can do is remove themselves as a source of uncertainty. I remember when I used to be in the UK, we used to complain that what was called the Chancellor would give out what was called budget lollipops. So that's kind of British English for saying once a year he'd have to make this announcement to Parliament about taxes and spending. And he'd like to mention a couple of headline grabbing things that people will get very excited about. And one of them I remember is called winter warmer, which was, pensioners would get, I think, £50 to spend a bit more on the heating. And then newspapers loved it. But of course, the process of standing up once a year and throwing out these lollipops generated a lot of volatility. So I think the most important thing politicians can do, in a sense, is tie their hands, sit back and do things like independent central banks and stable budget policy, because that helps remove themselves as one part of it. Now, of course, you still get technology and wars and other stuff you can't control, but at least control what you can. It's kind of like the serenity prayer for politicians. Accept what you can fix and then try and fix that.
Now, of course, the counter argument to that is that sometimes it's necessary to shake things up in the short term to be able to get better outcomes in the long term. So sometimes generating short-term uncertainty is a necessary thing to get to a better long-term outcome, right? So one thing that I did think was interesting about what you said is that generally the recessions associated with the spikes of uncertainty are actually quite short, as long as that uncertainty doesn't last too long. It's something that does seem to mean revert and doesn't seem to have that much long-term effect. And then you gave the example of Brexit. That was an example of more long-term uncertainty. If you think about the forces today Is your prediction that these are long-term uncertainty forces, or do you think that these are short-term uncertainty forces?
I think the political and AI are generating long-run uncertainty. So politics, my suspicion is that social media has, fragmented the media and it's generated an incentive for politicians to move towards more extreme positions. As a result, we have, in the US, for example, Kamala Harris versus Donald Trump were much more extreme than some of the earlier politicians. And, Trump has got into power. It has been quite radical in what he's done. That generates much more turbulence. We see that in Europe. I think that is a permanent factor. It's not so much about individuals because it's happening in many countries. So that I see as more permanent. The other angle on AI, I also see the, AI, the rate of acceleration is picking up, is getting faster and faster. So in both cases, I think uncertainty is now, it's going to be persistently high. So I don't see this as a short-run thing. So it looks a bit more like Brexit. In a sense, firms' cost of capital, their thresholds has risen because they add on a bigger risk premium. And there's just lower investment, lower R&D, lower hiring.
So Nick, what do you think firms should do about uncertainty?
I think there are three things they can do. One thing is you should try and become more flexible. So as in rent rather than buy, lease rather than, purchase. So what do I mean by that? You can rent equipment. Now, of course, it's more expensive than buying it. You can lease workers. You can have them on shorter rather than longer run contracts. But for that higher price, you get some flexibility. And right now, as in 2026, that flexibility is particularly valuable. Second thing is I would just pay more attention to politics. So there's that old Stigler saying, the business of business is business. Unfortunately, that is just no longer true. Politics is creeping into business. And so probably pay lobbyists if you're a big firm. Certainly be aware of what's going on. It's a valuable thing. It gives you a bit of future vision. And the third thing is have some sense of contingency planning. So it's interesting. When we look at the pandemic, there are some firms that have contingency plans. They didn't look like the pandemic. They looked like, internet outages and terrorist attacks. But those plans were somewhat useful and made them more fleet of foot. So, paying for flexibility, looking into politics and having contingency plans are three things that exec can do out there here and now.
I mean, of course, the flexibility, that's a zero-sum game. You can buy flexibility, but somebody else has to take it on. So there's a price for that flexibility.
Yes and no. So take AI. So imagine AI in an industry is going to, boost 50 firms and kill 50. If they're all 100 are set up to be flexible and they can return their capital quickly, that probably industry is net better off. So I think in that sense, there's a lot of volatility that's micro. And you just don't want, you don't want your capital bolted into the ground in financial structures that are hard to reverse and physical structures literally that are hard to reverse. So it's that kind of thing. And certainly for an individual business, in a sense, in an individual business, I don't mind if other people make bad mistakes. I just, I don't want to make a bad mistake myself. I
agree. Okay, well, Nick, it's been a great episode and a lot to think about.
Thanks so much for having me on again. And I love the show, as you well know.
Thanks for listening to All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. And be sure to catch our next episode by subscribing or following the show wherever you listen to your podcasts. For more information and episodes, visit alelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of the Lauder Institute at the University of Pennsylvania and the Graduate School of Business at Stanford University, and is produced by University FM.